Today I'm revealing external and internal range liquidity, the two liquidity pools that decide where price goes next. And in the next few minutes, I'll break it down in the simplest way possible. First, price moves within a range, and the old highs and old lows of that range are what we call external range liquidity. Everything that forms inside those highs and lows, all the little structure, swings, and pullbacks, that's internal range liquidity. That's the brief definition. Now let's jump to the chart. So on the chart, I'll first draw a box from this low to this high. Notice how between this low and this high we have a lot of structure? That entire structure becomes our internal range liquidity. And these 2 points, this high and this low, they are our external liquidity. So we will simply mark these external levels, and then we will wait until price takes out any one of these levels. And look closely. Price has just swept our external buy-side liquidity. When that happens, we expect price to move toward the opposite side, which is our external sell-side liquidity. But before it goes there, notice this bearish fair value gap. What is it? This is internal range liquidity, because the fair value gaps contains unfilled orders, which price fills by retracing back to these gaps and then continues towards the draw on liquidity. Now look at this low here. What is it? It's our internal sell-side liquidity. Our bias is bearish, so what do you think price will do? Price first retraced to this fair value gap, and then it swept this low right here. What I'm showing you is simple but powerful. Once the external levels are swept, we know price is likely to reverse and move toward the opposing external liquidity. And here's the key. We can use internal range liquidity to enter trades with precision, targeting those external levels. Now notice we have a new high. What does it become? It becomes our new external buy-side liquidity, and all the structure inside this range becomes our internal liquidity. Our bias is still bearish, so we'll use this internal structure to target the external sell-side liquidity. Let's wait and look for price to give us another opportunity. Once it will create any internal structure, we will look for opportunities. Now look at this. Is this a swing high? Yes. If we mark this out, what does it become? It becomes our internal buy-side liquidity. And here's the key. If this high gets swept, we know price will move toward our external sell-side liquidity. This is how we can read the price and plan the trades according to the internal range liquidity and target the external levels. Now we have marked our internal level from which we are expecting a run towards the external sell-side liquidity. Now we will just wait until price takes out this level. Now our internal high has been swept, and notice how quickly price rockets straight toward our external sell-side liquidity. This is exactly why understanding internal and external range liquidity gives you a massive edge in predicting price moves. So now our external sell-side liquidity has been swept. What do we do next? We wait for price to build new internal structure, and then we use that internal liquidity to look for opportunities that anticipate the next move toward external buy-side liquidity. Now we have a new external sell-side low, so I'm simply shifting the box from our external high down to this new external low. By doing that, you can clearly see we have a new internal range. So price created a fair value gap here, so I'll mark this out. But notice how price didn't retrace into it. Then it formed another fair value gap. And again, price didn't return to fill it. Now price forms a third fair value gap, and this time it actually retraces back into it. So we'll mark this one out as our active internal liquidity. And right after that, price sweeps our external buy-side liquidity level again. So you can see clearly, we had this fair value gap acting as our internal liquidity. Price moved lower, swept an internal buy-side liquidity level, and then dropped straight into the external sell-side liquidity. After that, price created these displacement moves and multiple fair value gaps, all part of our internal structure. Price retraced into this gap and then swept the external high. So by now, you should have a crystal clear understanding of what external range liquidity is, what internal range liquidity is, and exactly how price moves between the two. So thanks for watching this breakdown. If you want to take your understanding of liquidity, structure, and price delivery to the next level, make sure you join my Telegram and Discord communities. Inside, you'll get daily market overviews, setups, educational notes, and you'll be surrounded by traders who are growing and learning every single day. And if you're serious about leveling up, if you want direct guidance, clarity, and someone to personally walk you through improving your strategy, then check out the link in the description for my one-on-one mentorship. You'll get structured lessons, chart reviews, personalized feedback, and a lot more than I can share in a single YouTube video. So once again, thank you for watching, thank you for supporting the channel, and I'll see you in the next one.